Hi, do you know what markets have taught us this year so far? They've taught us that diversification matters. This is John Kamarianos. Welcome to a new edition of Capital Considered. Half the year is over. It's July 1st as I record. The half ended yesterday, and this first chart is going to show you how the world stock market did. We've got a red circle around two bars here. What does that mean? The first bar is the U.S. stock market. S&P 500 was up 10.21%. The second bar is the rest of the world. In other words, it's the world stock market minus the U.S. That index was up 13.68%. So the rest of the world beat the U.S. for the first half of this year, and that's actually a continuation of last year's returns. Why did the rest of the world do better? If you look at the bar to the left, that's foreign developed countries. They didn't do better. That's Europe and Japan mostly, Australia as well. But to the right of that red circle, to the immediate right, we see emerging market stocks, and they were up 23.85% for the half. They helped the rest of the world beat the U.S. in the first half of this year. If you held some emerging market stocks, or if you held a world index, you did better than just holding U.S. stocks. Finally, the bar all the way to the right is U.S. small cap stocks. They have woken up after a many years long slumber. They were up 23.9% for the year. Also a terrific year, or at least for the first half of the year. So that's the story with broad indices and broad markets this year. The lesson is diversification matters. Let's go to the next chart. This is the Magnificent Seven. These are the big seven tech stocks that have been carrying the market for years now, 5 or 10 years. They have faltered now, or at least some of them have. Microsoft being the worst one, all the way on the left here, down 22.53%. Meta, parent company of Facebook, down as well. Tesla down. And then we start to get into positive territory, but only mildly, with Amazon, Apple, Nvidia up 7.42%. Alphabet up 12.74%. So only one of these stocks, Alphabet, actually beat the S&P 500. So these stocks are faltering. This coming after the IPO of SpaceX, 2 more AI IPOs scheduled for this year. So we'll see if how those IPOs do, and whether this is the right time to issue AI-oriented or tech-oriented IPOs. Last chart here. Let's look at the price of gold. This isn't so much to show why diversification matters. This is to show how an asset class can change in a very short period of time. This is a 1-year chart of the price of gold in dollar terms. So a year ago, the price of gold was just over $3,000, between $3,000 and $3,500. And between July 1st last year and January 29th of this year, the price shot up to over $5,000. In other words, a 37% gain. It doesn't look like much because we have the y-axis on this chart going all the way down to zero, but that is in fact the 37% gain from last July 1st through January 29th of this year. And then since January 29th, its gold is down from over $5,000 to right around $4,000 for a 24.5% loss. So all in 1 year, gold is up 37% and then down 24.5%. So that tells you that you can be fooled by asset classes or stocks that are surging. You can also be fooled by asset classes or stocks that are declining. A lot can happen within a year. You can get whipsawed. You have to be careful. And if you're going to diversify, you have to stay diversified. It didn't do much good to add to it towards the end of January because you bought at the highs. So diversification matters. Asset classes can move pretty wildly within short periods of time. Those are the lessons for today. Coming to you from Rehoboth Beach. Thanks for watching. John Kamarianos for Capital Considered, signing off.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.